Hey all, welcome to ShareTreck. It's the 30th of April 2022, the Saturday. Have a great weekend while you're watching this video. And today's topic is basically a review of what happened this month and more so the last week of the month, because this has been one of the worst months for Nasdaq. And I would like to start off with a meme. This is what I saw on Twitter, and it kind of made my day because I thought, yeah, this is exactly how I feel. So with that said, let's get started. So here is the rundown of events for this worst month of Nasdaq. My dreams of selling to book profits and bottom fish in May have been dashed. While the market hits the bottom, most people do not have money to buy, and that is true probably of most of our subscribers out here. People are willing to sell at a lower price, but you actually either don't have the money or you're too afraid to buy because you think that it could fall further. So that's the situation, and this cycle will take a little bit to resolve itself, but that's where we are. And while we are looking at this market, Amazon tumbled 23.8% in April. That's a huge tumble for a blue chip like Amazon. I did buy some Amazon on the dips because the losses are mainly from Rivian, which in my opinion is a one-time charge. It's not going to happen again. And Amazon is also in the business of consumer staples, in my opinion. It will do okay in the coming months, and rewards will arrive in the third or fourth quarter of this year. That's my firm belief. So I put my money into Amazon, and dollar cost average down. So I'm happy about it. Meanwhile, Alphabet had its worst month, dropping 18% in April. Alphabet is also a buy as they have a good business, as well as they plan a $70 billion buyback, which is definitely going to register on its fundamentals. Because its EPS and other things will start looking good, and therefore it will shoot up. And also there is going to be a stock split, and that also gives a positive momentum in the near term because more participants can now afford the share. And the share volumes go up, the trading goes up, and it's a much more stable share going forward. Yeah, so those who have bought Google, I did buy a little Google. Not yesterday, but before. I wish I had enough money to buy some more Google. I couldn't. I chose Amazon on against Google because I already have a good enough number of Google stocks. Last 5 months or so, it seems that investors have been getting out of tech and out of growth sector. It has been more of a risk-off scenario than risk-on scenario. And as a result, we have seen many of our indices slowly coming down. And the tricky thing about our indices is that a few companies move those indices, and those companies were doing relatively well. Therefore, all the underperformance of various companies in the index was well camouflaged. But only when Amazon tumbled and Alphabet tumbled did we actually notice how bad it was, because then everything fell suddenly. So that's the lesson that I have picked up from this cycle. Don't go just by the index. Look at the companies that are driving the index. If most of the index is falling and the key drivers of the index are still strong, that means when the fall comes, it's going to be very steep. At least that's my lesson. We'll see whether it comes out to be true or not when we check it out next. Meta pulled a surprise, but the effect did not last very long because the very next day, that's on Friday, it dropped all the major gains that it had. It is still above where it was on Wednesday, but it's to the bottom of where it started on Friday. So that's where we are with Meta. Meta had been really beaten up, and when they came up with good results, the market was ready to reward them. And I suppose Meta sellers also had capitulated at that point of time. So we have had this bounce back. Talking about Apple dazzled, but the forecast was for a weaker quarter ahead. So after the initial jump on Thursday, the share prices came down back on Friday, same like Meta. The Apple share price came down on Friday to settle down where it started on Thursday. So most of the gains that happened after the open were kind of given up, but still they are up as compared to Wednesday. So that's what happened with Apple. We also have this new trend that the COVID revenues are falling for major pharmas. Most of the pharmaceutical companies that were capitalizing on COVID used to declare COVID revenue separately because they are running in billions of dollars. So right now, many companies have decided that they're going to merge their COVID earnings with the other earnings and not show it separately. Also, I think, if I'm not mistaken, Denmark has decided that they're not going to have any more COVID vaccines. So this could probably herald the end of the COVID era and the fall of COVID revenues. So those companies will have to look at other revenues for their revenue growth. So that is likely to be a bit of a dip because the COVID revenues suddenly spiked up the earnings of quite a few pharma companies. Now, all of them are going to have a drop, and then we'll also see corresponding drop in their share prices, and then a steady upward march as they start building up their revenues again. And in terms of financing, traditional funding for genomic companies is drying up, and this is what I found out when BlueBird CEO made a statement about the financial condition of his company and what they are doing in order to make sure that they have enough funding to complete their 2 candidates that are in BLA. If you have not seen my video about BlueBird earnings and what to expect from it, I dropped it yesterday. You can check it out. You can go to the channel, look for the video and get it started. And I'm also going to put a link to that in the description below so that you can easily pick it up and have a viewing of that. It's but understandable because interest rates being higher, it's going to be a higher cost of capital for companies, and therefore their production cost will also be higher. So sales cost will also be higher, so lesser market. And as a result, the break-even point for these companies is going to be stretched out further. And any income that comes in the future is going to be discounted at the interest rate from current times. Therefore, there's going to be reluctance on part of many private equity guys to put money into these companies. Therefore, I'm predicting that there's going to be more of mergers and acquisitions going on probably towards the next 2 quarters, next 3 quarters of this year, when big genomic companies might take over these smaller companies which have run out of money, because these companies have definitely developed a good portion of intellectual property that has not been completed. So the research can be taken up and there is value still in it. So that's possible. And another factor that I would like to bring to the attention of our investors, whether they are invested in BlueBird or any other company, is that when a company discloses that it has got financial problems and it's going to run out of money, and when it announces plans for cutting its workforce, there's a general demotivation in the employees, and also good talent starts looking for alternative employment. And as a result, the focus on the work and the progress that they could have made does definitely get compromised, in my opinion. So that's going to be a further tailwind drag on these companies as they proceed ahead. They may probably not meet their milestones as soon as that they thought they would if they had motivated and ambitious employees pushing the product with their and research with their full potential. Whereas now they would be looking at their own career prospects and where they're going to have continuity of employment. And that distraction is going to take the focus away from the milestones and the quality of work that is required to push many of these IPs to their logical conclusions. That's my opinion. And then speaking of Nasdaq fell 538 points on Friday, crashing through another support line. So now I would like to take you to the trading view chart so we can look at Nasdaq, and then we'll come back again to my talking points. As you can see here in Nasdaq, we had a huge drop. Look at this large candle. That's a huge drop. It's a drop of 536.89 basis points. That's around a drop of 4.17%. This is a huge drop, and we can see that we have dropped all the way from 14,577 straight right now to somewhere around 12,334.64. This is a huge drop, and we have fallen through another support of 12,560.87. I'm going to mark this red as a resistance, and our next support is going to be at 12,106.42, and we can see that the MACD is absolutely bearish. Momentum is also falling, and it's quite weak. I think the story at S&P 500 is also same. We have fallen through support of 415, and I'm going to mark this as a resistance. And if you look at our 2-year yields, it's continuing to go up. And as we mentioned earlier, as yields keep on going up for the 2-year or the 10-year, money is going to move out of growth and from tech stocks. And these are the headwinds that we are facing right now. Same thing for the 6-month yield curve as well. So it's all looking bad. Now, if you look at the VX, and we are inching towards the all-time high, which we briefly faced somewhere on, I think that was 21st of January 2022, where we touched a peak of 44.05. So we are inching close towards that. We have broken past this 38.27 resistance line out here, and we came back down and we closed the day just at the resistance. So you can see that we are all pent up for moving further up ahead on Monday when the market opens. And if we have some news about earnings pre-market, which is not good, then we have a very good chance of jumping through that resistance and converting that into a support. So with that said, I'm very pleased to announce that I'm going to add one more index to our watch list. It's called IDNA, which is the iShares Genomics Immunology and Healthcare ETF. So this is much more representative. I'm going to remove the IBB, which I was using earlier. We are not going to use that anymore. We are going to go for IDNA. And as you can see, IDNA has dropped significantly. And all this drop is going to be recovered in future. But right now, the question is, how far is it going to drop? So I'll be plotting a few support lines out here and resistance lines after recording this video. And we'll start looking at this on our daily updates going forward. And we'll start with looking at IDNA every day so that to get a general trend of where things are moving. And then we can start looking at all those genomic shares. So that's the plan going forward. So with that said, we have a statement from the CEO of Intel who is saying that the chip shortage is going to extend well into 2024. As we can see in the chip sector, the government has taken a lot of initiative to reduce the dependency on Taiwan. So they are putting a lot of chip development capacity within US. Now, there are going to be multiple things that are going to happen. First of all, the cost of the chips is going to go up because the cost of labor in the US is much higher than that as in Taiwan. And also the cost of operating a business in US is more expensive than doing that in Taiwan. Having said that, there is also the other aspect that we are going to have excess capacity. So there will be a huge production of chips, and therefore the price of chips are going to go down further. And that could kind of feed into Cathie Wood's theory that the raw materials and everything is going to become cheap. There is going to be oversupply, and that's going to result in more innovations coming up to fill the gap. And therefore, cost of products and everything will become much cheaper. So that whole cycle that she was talking about is most likely to be triggered because of easy availability of chips. We are looking at the price of NVIDIA and AMD, which have come down significantly. In my opinion, I think the market is pricing in the fact that right now there's a shortage and later on there is going to be a glut. And therefore, the future revenues of these companies are going to be lesser and the margin is going to be lesser. That's how I think the market is looking at them. So we'll have to wait and see what happens in that regard. Meanwhile, we have Cathie Wood tripling down on Teladoc. Suffice to say that she can only explain her thesis as good as possible. So I'm going to play a small clip of what Cathie Wood said and how she justified investing in Teladoc not only a day before the results, but also after the results, and going all in on Teladoc. It's a very inspiring clip. Have a listen and let me know what you think. Put it in the comments. It will be a good point of discussion.
Me now is Cathie Wood, the CEO and CIO of ARK's owner, ARK Invest. Cathie, welcome. We all give you credit for coming on to talk about why in the world you bought $20 million more of TDOC yesterday, right?
Sure. Hi, Kelly. And yes, I'd much prefer to come out at this time than to come out and be all over media when things are when stocks are soaring, because I think this is our best value add. Yes, Teladoc, very, very tough quarter. And that's particularly for investors who are quarter to quarter oriented. As you know, we have a 5-year investment time horizon, but as fears about inflation and interest rates have moved up, time horizons in the market have shortened to basically a quarter. And so the analysts picked apart the quarter and zoomed in on the direct to consumer business, which did have a shortfall. There's more competition in that space as VC, as venture capital is financing some companies who are getting into niche areas. Now, our point of view is that that Teladoc is becoming the healthcare information backbone of the United States. It serves 16% of Americans are paid users. And whenever we look at S curves, we are looking for that 15 to 20% range as a trend moves into that market share. That is the beginning of an S curve. And the story is not direct to consumer for Teladoc. Certainly that was a big booster during COVID. The story here is much bigger. It's business to business. What was not mentioned, and no questions about Northwell, the New York or tri-state area hospital system that Teladoc has won, took it from another entity. And what was also not mentioned is Amazon's decision to partner with Teladoc as opposed to compete with it. The stock had been beaten up regularly over the last year as Amazon said, we're going national, we're going national. And instead, Amazon has capitulated and at least is going to partner for some healthcare services and certainly through Alexa with Teladoc.
Sure.
So I think the story here is huge. When you think about healthcare as 20% of the U.S. economy, so a $4 trillion ecosystem, the waste there is at least $400 billion.
Sure.
We would submit most of because this healthcare information system connecting patients, doctors, insurance companies, and hospitals has not been put in place. This is a winner-take-most market. And we feel that, yes, short-term, there was an earnings shortfall. They had to cut estimates, admit that. We're looking 5 years out. We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
Meanwhile, we have Elon Musk selling $8.5 billion worth of Tesla shares to buy Twitter. He's going to be the most indebted billionaire once the financing is complete and Twitter ownership is activated. The Tesla shares have responded by falling significantly, not only due to the fact that Elon has been dumping shares of Tesla in huge quantities to fund his Twitter purchase, but also because shareholders are concerned that Twitter will be a distraction and would compromise the potential pace of progress with Tesla. And personally, I'm not only concerned about the pace of Tesla, I hold some shares of Tesla, but I'm also concerned about those mega projects like the Mars mission, the Boring Company, and the electric solar cells, electric battery, all those cutting edge research that has been happening under the Tesla banner getting delayed. So coming back to the point of this week, I think that the profession of a financial advisor is a very difficult one. The question is, can anyone realistically predict the market? Okay, we have technical analysis, we have fundamental analysis. At the end of the day, everything is the view of the investor, and individual investors are following their own gut and they're listening to 10 or 20 different people, and that's what is moving the markets. There are so many factors that determine the trajectory in the market. So there is macroeconomics, microeconomics, geopolitics, and there are also spontaneous events that change the course of the market price action. It's very tricky. I admit openly that I don't know what's going to happen when I don't know it. When I have some kind of a hint from technical analysis, then I put a caveat that this is what it looks like, but things can change. That's how I approach it. But people who make it a living, being financial advisors or being analysts, it must be a tough life for them because they can be wrong 99% of the time, and 1% of the time, if they are right, then they get into the Hall of Fame and people start following them. And they have a lot of goodwill in them. And I think Cathie Wood probably is riding that kind of a goodwill. And she just needs one hit to again become a mega fund manager. I find it very difficult to predict my own portfolio. So I don't know how these guys can predict other people's portfolio and other people's money and have a good night's sleep. So that's for another day. I'm going to show you a news clip that I saw today. And I'll also put the link of that in the description below, and we can talk about that subsequently. The news item says C2i Genomics snags European approval for a blood test to detect residual cancer. So it seems that this company has got its R&D in Israel, and it's a US company. It seems to have the capability to take around 3 ml of blood, and it has got a software as service model, and it also recently got $100 million funding to enhance its software capabilities, and it can detect residual cancer. So when people are in remission from cancer, there is still a residual amount of cancer floating in the blood, and surgeons continue giving them some dosage of chemotherapy or radiation in order to remove the residual cancer. With the service from CI, they are able to detect it more accurately and calibrate their dosage for chemotherapy or radiation in a much more fine-tuned manner, and therefore the outcomes are much better. So this is really a good outcome, but this company is private. Therefore, we are not able to participate, but we'll keep track of what this company continues to do. Now, let us look at our earnings for next week. So when you look at the earnings for next week, you can see that we have some big names coming up. It's not heavy lifting on Monday, fortunately for us. And before open, we have On Semi, then we have Berkshire Hathaway, which could probably move markets. If Berkshire reports good results and also a good outlook for next quarter, we can be sure that the resistance will work, and VIX will fall down from there, and probably will go back and test resistance in Nasdaq. That could happen with Berkshire Hathaway, but there is no other major reporting in the morning. After close, we have reporting from Expedia and Avis, which I'm interested in because they can show whether travel has restarted. And we also have a hotels company, High Resorts. So those companies can give us an idea whether post-pandemic travel has recovered. And if that is the case, that bodes well for the market. On Tuesday, before market, we have Pfizer. So we'll get some indication on what Pfizer is doing, and that can definitely influence the genomics market. We also have Biogen reporting, we have Teva reporting, and we do have Estee Lauder, the cosmetics company, that can show consumer spending on discretionaries, how it is trending, and if they anticipate a weak quarter ahead, that means consumer discretionary is going to go down. We also have Hilton, which could show us post-pandemic travel patterns. After close, we have AMD, so we're going to look at what their outlook is for the next quarter, and what their plans are for increasing their chip capacity. We have Airbnb, which is again going to show us post-pandemic movement, whether the travel has taken place, travel appreciation has taken place, whether we are back to previous levels, and what the next quarter looks like. Then we have Lyft, which is also going to report. We have Caesars Entertainment. Again, this is going to be holiday travel and discretionary spending. So all these will give us an idea of what the next quarter looks like, and they will also drive the sentiment for Nasdaq. We have Moderna coming up before market open on Wednesday. It will be watched closely. CVS Health is coming up, and then we have Regeneron reporting. Of course, I've already put a what to expect video for Regeneron. You can check it out. I'll also put it in the description. You can check it out on the channel. We have Marriott International coming up with their reporting. This will again show whether post-pandemic travel has started and what the outlook is for the next quarter. And after close, we have Uber reporting, Etsy reporting, Twilio reporting, and we have Marathon, which is going to report. Again, that's, its fortune is tied with Bitcoin. We can see what their cash position is looking like and whether it is looking like it's still economical to mine Bitcoins, or have they stopped mining for the time being. So we'll get all that information. And then on Thursday, we have Shopify reporting before market open. If they have a surprise and if they have a good outlook, there is going to be good money to be made for those who have bought Shopify in the dips. And then, of course, we have got Wayfair, which again is going to show whether there is a discretionary spending that's happening. And after close, we have got Fubo. We got Lucid. Whatever Lucid reports could give us an insight into how the EV market is going to perform. We have Cloudflare, of course, and we have Vertex, which is coming up. I'm going to be putting out a video on Vertex, what to expect in the Q1 earnings call, just like I did for the other companies which are reporting on 4th of May. And finally, we have DraftKings, we have Under Armour. We'll see what all these earnings are going to do to the Nasdaq and how the price action moves forward. For most of the genomic companies in our watch list, that'll be a short video which talks about what to expect from the earnings call on Q1. If you like those, please let me know in the comments. I've already released 3 of them. You can check it out. And if you like this video, please press a like so that more people can discover our channel, as YouTube will broadcast this to a wider audience. And if you're not yet subscribed, please subscribe. There is nothing to lose. There is no tax. There is no cost to it. And it will make me happy that we have more subscribers, and it will give me more enthusiasm to come up with more videos. Thanks, and have a great day and a wonderful weekend. I'll catch you up tomorrow. Bye for now.